Welcome to the Pro Ticker Deep Dive. The S&P 500 just keeps pushing higher, doesn't it? Record territory again. And, well, the big question everyone's asking is this broad-based confidence? Is everyone jumping in? Or is it something else driving this climb?
Is it just a few aggressive players, maybe?
Exactly. So today we're going to dig into investor positioning, look at the flows, really try and figure out where the risk appetite is concentrated and what that means going forward.
That's really the core mission here. Because the sources, they show this fascinating split. The market's definitely up, no question.
Yeah.
And yeah, you see those pockets of momentum chasing you'd expect.
Yeah.
But overall positioning, it's not yet at those, extreme highs that typically scream sharp reversal ahead.
Yeah.
We really need to unpack the difference between, say, systematic, rules-based funds.
The algorithms.
Right, the algos. And then the traditional discretionary human managers. They're telling two very different stories right now.
Okay, so this is where it gets really interesting for you listening. We're going to look at that gap between these two investor types. It seems pretty dramatic.
It is.
We'll also look at some hard evidence, like actual proof, that investors are chasing gains in certain spots.
Yep, localized chasing.
And finally, we need to talk about the critical factor that's really driving equity performance. And spoiler alert, it's probably not what you think. It's not the actual interest rate level.
Definitely not the level itself.
Right. So let's start with that broad positioning picture. The S&P hits new highs, but overall equity positioning, it's only at a 1-month high.
Yeah, just a 1-month high. It's described as moderately overweight. If you look back since 2010, it puts us right around the 69th percentile.
Okay, 69th percentile. So moderately overweight, that doesn't sound like extreme euphoria yet.
Exactly. That's the point. It
Yeah.
tells you where the risk isn't, maybe. Historically, about 31% of the time, investors were actually more aggressive than they are today. So yeah, we're overweight, sure, comfortable, but not yet in that, lopsided territory where a big reversal feels imminent just based on positioning alone.
But, like you said, that average number, it hides this big split inside. Let's talk about that, the tale of two investors.
Precisely. On one side, you've got the humans, the traditional discretionary fund managers, and they are, frankly, surprisingly cautious.
Still, even with these highs.
Still, their positioning is largely neutral. Think 44th percentile. They've been hesitant, really haven't fully bought into this rally, which, means they have plenty of room, plenty of dry powder to catch up. If the macro picture stays strong, earnings hold up.
So they could still jump in and push things higher.
They could. They're sort of the hesitant bystander right now.
Okay, so the human managers are acting like this could fizzle out, but the machines, the systematic strategies.
Oh, completely different story. They are acting with, maximum conviction, seems fair to say. We're talking CTAs, commodity trading advisors, volatility control funds. Their positioning is clearly elevated, way up there at the 92nd percentile overall.
Wow, 92nd. That's high.
It's very high. These rules-based systems, they're essentially maxed out based on their own risk models.
Can we get more specific? Like, how committed are they, really?
Sure. So volatility control funds, the ones that automatically buy stocks when volatility is low, they're estimated to be near their historical maximum equity allocation, like 100 percentile.
100%. Okay.
And CTAs, their overall long position in equities is also nearly tapped out. That's the 93rd percentile. And it's global, too. They're adding longs heavily in the U.S., S&P, NASDAQ, but also Europe, EM, Japan.
Right. So this is really key for you listening. The systematic money, the automated stuff, it's acting like a massive amplifier right now. Highly committed, probably leveraged.
Pushing the market up based on its rules.
Yeah. But the discretionary money, the human managers, they're still kind of standing aside.
Which creates a specific kind of risk, doesn't it? If volatility suddenly spikes, those systematic funds, they don't think, they just sell automatically.
Could be a much sharper downturn than if the humans were fully in control.
Exactly. An automatic, potentially self-reinforcing sell-off.
Okay, so that brings us to these pockets of, let's call it, exuberance, the momentum chasing.
Yeah, because with the systematic guys all in and the discretionary guys hesitant, you see this very focused, short-term, aggressive behavior.
And the evidence is pretty clear here.
Oh yeah, quite compelling. We can track a basket of stocks, the ones with the highest net call volumes from the previous week.
So where people were betting on prices going up with options.
Right, and guess what? That exact basket rallied hard this week.
Yeah.
It's pretty definitive proof investors chasing last week's winners, risk appetite soaring in specific targeted spots.
And it's not just retail options players, right?
No. We see it in institutional money, too.
Right.
Inflows into funds that specifically target momentum strategies. They hit their highest level all year this week.
Wow.
So the market isn't just drifting up. It's actively rewarding that high-speed, momentum-based trading, and money is flooding towards it.
And the psychological shift? It seems incredibly fast. You look at investor sentiment surveys, the bull minus bear spread.
Yeah, that was amazing. Just a week ago, it was near extreme lows, really pessimistic.
I know.
Snapped right back, sharply. Back to neutral, around the 34th percentile, almost overnight.
That speed is something else.
It really is. Bullish responses jumped to their highest since early July. But what's maybe most revealing, neutral responses, they collapsed, down to the 2nd percentile.
So people didn't just get less bearish, they went straight to bullish.
Pretty much. They just ditched the extreme pessimism and jumped right over neutral into active bullishness. Well, it's often driven by emotion, right? Fear of missing out. FOMO.
It definitely sounds like FOMO. But okay, let's keep some perspective. Not all risk dials are turned up to 11.
No, and that ties back to that overall moderate positioning we talked about.
Yeah.
There are caveats. If you look at, say, leveraged ETFs, single stock ETFs, the really aggressive retail corners, inflows there are still subdued.
Subdued.
Yeah, in fact, leveraged funds are still seeing outflows. So while momentum is hot in places, you can't say everyone, including the traditionally less sophisticated money, is universally piled in yet.
Okay, makes sense. So speaking of money moving,
Yeah.
let's talk flows. Huge equity inflows this week, right? Like near record.
Yeah, $68 billion total.
Yeah.
Dominated by the U.S., about $58 billion went there. It sounds like a tidal wave.
It does. Shouldn't that alone make the S&P jump even more?
You'd think so, but context is everything here. That massive number, it's actually entirely consistent with typical seasonality for this specific week in September.
Oh, really? So it happens most years.
Pretty much. It often looks like a huge conviction shift, but it might just be, well, the calendar turning. Historically, these flows tend to peak right around now. We might even expect a bit of a lull in the next few weeks.
Before maybe ramping up again later in the year.
Exactly. So less of a revolutionary stampede, more like an annual tradition, perhaps.
Okay, but still, where did that money go within the market? Did it validate that broadening idea?
Ah, yes. It absolutely confirms broadening. Investors weren't just buying the same old mega caps. They favored cyclicals, value plays. Industrials, for instance, saw their biggest weekly inflows since way back in November 2016.
Wow, okay.
And financials, materials, healthcare, telecom, all got notable inflows. It shows a clear shift.
And small caps too, right? Big move there.
Huge move. Positioning in small caps jumped sharply into overweight territory, hit the 78th percentile. That shows real belief that the rally is healthy, extending beyond just the giants.
And money came out of defensives.
Yep. Consumer goods, utilities. Saw outflows? Another sign investors are feeling comfortable taking on more cyclical risk.
Okay, and briefly, what about other assets? Bonds, cash?
Bond inflows slowed a bit, but still strong, around $14 billion. Money market funds, though. They'd soaked up a ton of cash recently, over $265 billion in 6 weeks.
Wow.
They saw their first outflows in 7 weeks. Just a trickle, maybe, but it's just some cash is finally coming off the sidelines.
Interesting. And CTAs are betting against the dollar.
They are, adding short positions in the U.S. dollar, pushing exposure near extreme lows. That's usually a global risk-on signal. They're also trimming some long copper positions, which were at extremes.
All right. So let's get to this final, really crucial piece. The driver behind all this. You said it's not the rate level.
Right. It's the volatility of rates. This is so often misunderstood, but it seems to be the key support right now.
Okay, explain that. Like, look at the Fed meetings. The S&P often goes up after the announcement, right? 9 of the last 12 times, I think.
That's right. A median gain of about 0.5% the day after.
Why is it so predictable?
It's not magic, it's just volatility mechanics. Leading into an FOMC meeting, uncertainty builds up like crazy. That creates a premium, an extra cost, baked into equity volatility. Once the Fed makes its announcement, poof, a lot of that immediate uncertainty disappears. The premium collapses. And the market can rally simply because a big question mark is gone.
So the relief rally is actually a volatility crush rally.
In large part, yes. And that leads directly to the core driver for the broader market. Equities seem much more sensitive to how much rates are moving around their volatility than to their absolute level.
That difference is huge.
It's profound. It might be the single most important factor underpinning this whole rally.
Yeah.
Think about it. High rates volatility creates massive uncertainty for company valuations, for cash flow models.
Yeah.
It makes equities really struggle.
So the market doesn't mind 4% or 5% on the 10-year yield as much as it minds it whipping back and forth unpredictably.
Exactly. It hates the instability. And the good news for stock bulls is that rates volatility, you measure it with things like the MAVI index, kind of the VIX for bonds. It's just kept trending lower and lower.
And where is it now? That's the key.
It's back to levels we last saw in late 2021. That's before the Fed even started its really aggressive tightening cycle.
Whoa. So pre-tightening levels of bond market calm.
Essentially, yes. This return to structural stability, this calmness in the bond market, it's like the smooth road that's letting the equity market engine accelerate again. Even if rates themselves are higher, the ride is smoother.
Okay, that makes a lot of sense. The calmness is feeding the confidence.
Precisely.
All right, let's sum up this deep dive then. We've got this major split. Systematic investors are basically all in, maxed out,
Highly leveraged, yeah.
while the discretionary human managers, still cautious, but maybe warming up, peaking out.
Plenty of room to buy still.
Meanwhile, momentum trades are definitely working in specific areas. People are chasing gains there, backed up by huge, although maybe seasonal, fun flows into cyclicals and small cap.
Flattening out, yeah.
And the whole thing is happening against this backdrop of surprisingly low and falling interest rate volatility.
That's the crucial support structure.
So the final thought, what's the key thing for listeners to watch?
Well, it really comes back to that systematic versus discretionary tension. That's the core dynamic right now, I think. The market's riding high on the machines, the automated systems being fully committed.
Okay.
So what happens if that discretionary crowd, the humans, finally gives in to FOMO and really jumps in? All that sideline cash could push prices much higher, right?
Could be another leg up.
Could be. But the flip side is the risk concentration. What if some unexpected shock hits? Something that does spike volatility. Those maxed out systematic funds, they have to sell automatically. No hesitation.
A forced, sharp unwind.
Exactly. A compulsory selling event driven by the machines. So that split, the all-in machines versus the hesitant humans, that really defines the immediate risk profile you need to keep a very close eye on in the coming weeks.
Fascinating stuff. Okay, that's our deep dive for today. See you all in the next Pro Ticker Deep Dive.